There is a debt crisis in America, but not the one you've heard about. In recent years, personal interest payments in the US have skyrocketed, reaching a staggering $561 billion. This is an 11x increase since 1981, despite a federal funds rate that is one-fifth of what it was then. In this video, we'll dive into the consumer and their debt. So here is the nominal personal interest payments. This shows the number of dollars that Americans are spending on interest, whether that be credit card loans, car loans, mortgages. And we can see that since the end of the gold standard here in the early 70s, this number has absolutely skyrocketed. In the 70s, this number was about 19, 20, 25 billion dollars of interest that Americans were spending. And we can see that currently it is $561 billion per year. Here we see in red government debt to GDP. So if this line looks familiar, it's because government debt to GDP, sovereign debt to GDP, has followed generally the same direction of travel. And with this red line, we are looking at government debt as a share of GDP. GDP is the ability to service debt. And so in any conversation about debt, it's important not just to look at the nominal level of debt, but as a ratio. And for the average American, that's as a ratio to their average hourly wage. And so here we see personal interest payments divided by the average hourly wage. And what this shows, remember, as if the numerator is increasing faster than the denominator, this line will go up. And so what we can see is the average, the personal interest payments for Americans has been increasing faster than their wages. And so, like we mentioned with government debt to GDP, it's important to kind of measure this ratio because this is actually the important metric. This shows the ability of the person or entity to service the debt. And we can see here that it's basically right at an all-time high. The other way to think about this particular red line here, personal interest payments divided by the average hourly wage, is that this number tells you the number of hours of work in America to pay interest for normal everyday Americans to pay interest, whatever that be, cars, mortgages, credit cards. And we can see that, again, going back to the late 60s, early 70s, this is about between 4 and 5 billion hours of work to make interest payments. Now that number is 18 billion. So every year, 18 billion hours are being spent working in America in order to pay interest payments to commercial banks. And so this is despite a federal funds rate that has been declining. And here in teal, we see the federal funds rate. And this is the overnight interest rate. This is the one that you hear, Jerome Powell and all the discussion on the news. This is what they're talking about. It is the overnight interest rate. This influences interest rates for things like credit cards, mortgages, personal loans. But it is important to make a caveat that those sort of debts and loans are priced more so off the 10-year treasury than they are the federal funds rate. But in general, this blue line gives a pretty good direction of travel, pretty good indication of kind of the direction of travel of interest rates. And we can see that, in the early 80s, the federal funds rate, the overnight interest rate, reached 19%. And basically ever since then has been declining. And you can see this general downward trend in the blue line. This is the kind of secular period of declining interest rates. Well, we see personal interest payments either nominal or as a share of average hourly wage, doesn't really matter, have been increasing. So as rates have been falling, people have been levering up and taking on more debt. This goes to the hyperfinancialization concept that we covered. I'll leave a link to that at the end of the video. I think it's a really important concept for people to understand, and it ties into a lot of kind of broader themes that are being discussed right now. So I'd highly recommend people watch that if you haven't already. Here, unfortunately, this data only goes back to the early 2000s, but here in purple we see the total overall credit card balance for Americans. And we can see that they have levered up. After 2008, This purple line fell, credit card balances fell down to about $650 billion. This is normal during a recession or an economic contraction. There's this called deleveraging. So as people take on debt, whether that be people or businesses or governments, that is leveraging. And then as those debts are either defaulted on or paid off, reduced, that is called deleveraging. And so we can see that there was this deleveraging that occurred, in the wake of the great financial crisis from December of 2008 down to the bottom that looks like May 2014, March, April of 2014. And ever since then, the credit card balances have doubled. So about in the past 20 years, um, the overall credit card balance has doubled in America from about, like we mentioned, about $650 billion all the way up to $1.2 trillion. And so here we see the interest rate on that balance. And we can see that in the at the low following the great financial crisis, the average rate on a credit card was about 11.5%. Now, today, that rate is 21%. So again, the overall balance has doubled, but so has the interest rate. And again, I think it's important to kind of put that into contrast versus this blue teal line, which is the federal funds rate. This is the overnight kind of official government interest rate. And what we can see is that again, the federal funds rate is really not notably higher. It's only at a level that we saw kind of leading into the great financial crisis 20 years ago. It is basically flat back to that period of time in '07 and '05. But yet the leverage that normal Americans have taken on and the interest rate, the cost of that debt, which is what we see in green, has exploded higher. So here's a percentage chart. So what this shows here on the right is the percent change since the start. And I made it the end of the gold standard in 1971. But what we can see is personal interest payments have increased by about 3,385%. The average hourly wage here in yellow, this is just another way to represent this red line that we were looking at. That's government debt. It's another way to kind of visualize this red line here. And the average hourly wage has increased by about 760%, and personal savings, which we see here in red, has increased by about 700%. And so what this indicates is this shows the delta, the difference between how fast personal interest payments have risen versus the average hourly wage. And we can see that they have the personal interest payments, the cost of debt for the average American has increased notably higher, notably more rapidly than their wages have. And so if you multiply 7 by 5, it gives you about the rate of increase for personal interest payments. So you can say that personal interest payments have outpaced the average hourly wage by about 5x since 1971. And again, this is what you see during kind of a leveraging event or a period of time in which leveraging is occurring. And the other thing I think that's notable is this personal savings. We can see that since going back to the to the kind of early to mid 2000s, personal savings have been basically flat. Americans are not saving money. And it's important, I know it's not the exact topic of this video, but it's important to really kind of nail down on this concept because so much talk about it right now. America runs a twin deficit. What this means is that we are importing the value of the imports, the value of the stuff that we are buying from the rest of the world greatly outpaces the money that we're making from selling to the rest of the world. So some people have kind of, made this analogy that, if you spend $10,000 a year at the grocery store, you run a $10,000 trade deficit with the grocery store. And I think that analogy can work, but the part people never talk about is the other side of it. Okay, so maybe you make 80K a year and you spend $10,000 a year on groceries. That sounds perfectly reasonable. Okay, well, to make it equivalent to America, you don't make any money. You have no income. Actually, you have negative income. So not only are you spending $10,000 a year at the grocery store and running a $10,000 trade deficit with the grocery store, but you don't have any income. In fact, you have negative income. This is the fiscal deficit. So when people talk about the twin deficit of America, they're talking about the trade deficit, which is the value of imports relative to the value of exports. But then there's the fiscal deficit, which is the government revenue versus government spending. And in America, we run a twin deficit. We run a trade deficit and a fiscal deficit. So what this means is that the only thing that our country, generally speaking, in the very macro sense, the only thing that our country can accumulate is debt. In a twin deficit nation, this is not really that surprising to see this kind of leveraging that we've been talking about. It's really not surprising when you consider the fact that America has been running a twin deficit. In a twin deficit nation, you do not produce enough value for the rest of the world to offset your consumption. Right? We are over consuming, just kind of by definition, when you run a twin deficit. And we are consuming more value than we are producing. Put another way, this is, the American economy is not net productive. On a net basis, we are not producing more value than we are consuming. Now, if you apply this to kind of back to the to the to the everyday American, to the blue collar American we're looking at here, this is basically, imagine you make a 80K a year, but you're spending 100K a year. Then the next year you're spending $110,000 a year. Your income didn't change, right? You're still making 80K a year, but you spend ever more and more and more in excess of your income. This is basically, what we see with America. We are running ever larger twin deficits. We are consuming more value than we are producing. And that is equivalent to, you make 80K a year, but you spend $100,000 a year. And then the next year you spend $110,000 a year. And then the next year, 120, right? And you just keep kind of taking on more and more debt because it's the only way that you can really survive. This is basically what we see with America, not just on the government side, but here we're looking at the personal side. And we can see that kind of dynamic of this accumulation of debt or this leveraging is the same for the average American who is not saving, right? How can they save when they're consuming so much? And also, how can they save when they're spending so much money on interest, on the cost of all that debt that they accumulated? So here we see in white personal interest payments divided by the median sales price of a single family house. Some people might be thinking, okay, well, the average American has definitely levered up and they are kind of under this significant debt burden, but they have assets. And so here we look at kind of the biggest asset of them all, which is someone's home. Now, if you're 20 or 30 years old watching this, this is, doesn't apply to you. You can't afford to own a home. But, for the older, Gen Xers and definitely the boomers, they own assets. So here we see in white the personal interest payments relative to their assets. So again, as this white line is going up, that means personal interest payments are rising faster than the value of their biggest asset, which is the sale, the value of their single family home. And so what we can see is that even kind of taking into account their assets, this is still basically at a record. The last time that it was that this particular metric, personal interest payments divided by the sales price of a single family home, the last time, really the only other time that this number was this high was the peak of the dot-com bubble. And what we can see is, these kind of deleveraging events that occur during recessions. And so here, because we mentioned housing, and I've never showed this chart I think is really important to really drive this concept home, because I've never shown this chart on YouTube yet, but this is one of my favorite charts. So this takes the median sales price of a single family home and divides it by gold. The other way to think about this is it is the number of ounces of gold to buy one house. And what we can see here, I made red unaffordable and green more affordable than it is now. So anytime you see red here, that is indicating that it took more ounces of gold to buy a house at that time than it does now. Anytime you see green means that housing was more affordable, right? You didn't need as much gold to buy that house. And we can see here that, in the early 80s, this number was as low as like 98, 99 ounces of gold to buy one house. But really outside of this, like, couple month period in the early 80s, and then again, this very, very brief, quarter during 2011, housing has actually never been more affordable in real terms. So if you're younger and you can't afford a home, or maybe you own a home, maybe you're a boomer and you have, a home that you bought 20 years ago, 30 years ago, you're looking at your Zestimate on Zillow, and you see, it's quadrupled. Well, the value of the home, what this chart shows is that the value of the home did not actually increase in real terms. It's actually housing has actually never really been cheaper. Um, what that is indicating, the fact that the price went from $80,000 for your home to $500,000 for your home, what that indicates is that the value of the denominator, the value of the dollar, has fallen that much, right? It is not that homes got any more valuable. Now, people may quabble about that and say, well, they're slightly larger than they were 10 or 15 or 20 years. Okay, sure, there's some degree to which a marginal degree to which the average home nowadays is slightly larger, or might have slightly better technology, might be slightly more energy efficient, or these kinds of things. But in general, we're talking about 670 ounces of gold to buy a house in the early 2000s at the peak of that kind of early 2000s bubble. It took about 670 ounces of gold to buy a house. That number now is 130. So, whatever marginal kind of, increase in size of the average house, or the increase in the, energy efficiency of a modern day house, I'm sorry, but it's not the difference between 670 ounces of gold versus 130 ounces of gold. That is, we're talking maybe 5% more valuable in real terms, energy efficiency slightly larger, 5 or 10%. We are not talking about 5 or 10% here. Um, and so when you think about assets, when you think about debt, I think it's really important to remember that the value of assets, a huge degree to which you log into your brokerage account or you look at your Zillow estimate and you see the value of assets in dollar terms is higher. Um, that is not so much that that underlying asset got more valuable. What that means is that two things. One, the value of the dollar has fallen by that much. We point this out all the time with gold. Gold is up, I think, about 65% over the past 12 months. Gold didn't get any more valuable. Gold is still gold. It is just a shiny rock. The reason the US dollar price of gold has risen so much is because the value of the dollar has fallen that much, that it takes that many more dollars. Dollars are more worthless. You need more of these worthless dollars to buy the same thing, which is an ounce of gold. And so I think that, really reorienting your mind when it comes to looking at debt versus assets, you want to make sure that your assets are actually outpacing that kind of debasement, right? Because assets, whether it's S&P 500, single family home, um, gold, Bitcoin, any of these assets will go up and to the right. This is just the nature of the system. But what you want to really kind of nail down on is, are they going up and to the right more than the currency is losing value, right? So on average, M2 increases by about 7.5%, 8% a year. The money supply increases by about 7 to 8% a year. Depending on the time period you look, sometimes it's as high as 9.5%. So that is the real inflation rate. That is the degree to which dollars are being diluted. So again, I think it's really important for people to try to start thinking about this as we head into what I believe to be, a significantly different regime in terms of kind of overall structure of the economy, politically, right, with more rising populism, all these concepts we've been talking about here in our videos. I think it's important. We are likely to see higher rates. In our opinion, we are likely to see higher rates. Interest rates move in long lifetime cycles. A number of very smart people like Peter Turchin, Neil Howe, and Strauss, these guys have looked at interest rates going back hundreds and hundreds and hundreds of years and have found that interest rates historically move in these kind of long lifetime cycles. So call it 70 years, 80 years. And we have been in a period of time of falling rates going back to the early 80s when the federal funds rate was 19%. In general, the cost of debt has been falling. But what we're trying to highlight here is that the burden of that debt has been increasing. The cost of that debt has been increasing just already, right? Like the federal funds rate only went from 10 basis points to 4. If our thesis is correct that we are in a period of we are about to enter a period of kind of higher, structurally higher rates, this will likely go higher. And I know that sounds crazy to most people that are younger that have gotten used to ZIRP, zero interest rate policy, QE, this kind of easy money regime that we've been living in for the past 20, 30 years. But, a number of people much smarter than me are also in agreement that we are likely to see higher, structurally higher rates. So what that means is that, if the burden of debt has increased, if the burden of the debt has gotten so much worse recently with just a move in the federal funds rate of 4%, what happens when this thing goes to 5, 6, 7, 8, 9%? The burden of the debt, it's important to remember the cost of all this debt that Americans have taken on. Um, so long as we run a twin deficit in general, as an economy, as a country, we will continue to accumulate more debt. And so I think it's important for people to start thinking about the cost of that debt and what the cost of that debt might be, moving forward in the future. So hopefully that was helpful. Leave a comment if you had any advice or learned something new. Just trying to help people. So can't always hit every point that we want to, but hopefully in general, added some value, gave you a way to look at things. Talk to you guys later.